Hello and welcome to the second episode of our Eye on Insurance, the IBN Money special that answers all your insurance queries. Today we'll clear more doubts about life insurance, add in educational insurance and also talk about medical insurance. And to answer all that, we have our expert, Mr. Karthik Zaveri, Director of Transcend Consultancy. He joins us from Mumbai. Okay, first let's get you learnings from last week, and it's not rocket science. Well, for most of you all, first lesson number one, insurance should not be looked at as an investment. It's the way of covering risks in the case of an eventuality. Second, term life policy should be preferred because endowment and money back means a far higher premium. Well, we'll get lots of mails from viewers agreeing to what we are saying, and also there are those who do not agree strongly. Well, first, let's get the non-believers. First, Mr. Arun Gopalan, a financial consultant from Pune, strongly disagrees with our views that insurance is not an investment. He argues that insurance companies nowadays give returns that are more than 20 to 25% per annum in unit-linked plans. And in comparison to mutual funds, unit-linked insurance schemes are far better on the long run. That's what he says. And Mr. Gopalan, well, is not on the phone line or live, so I'll play the devil's advocate. So Karthik, should insurance be looked at as an investment, especially in today's context with booming markets?
Well, I reiterate, insurance should not really be looked at as an investment avenue. Now, what happens is unit-linked policies tend to give you the facility of having insurance and investment as a combination. But when we say that ULIPs have returned high rates of return over the last 2-3 years, what we forget is that ULIPs have actually entered the Indian market only in a boom time. We've never seen a bust time with this. The loadings are high, the expenses are high with ULIPs, and over a period of time, if we see a bear market, it can actually erode wealth as well and can take a long time to cover up. The fact whether mutual funds and ULIPs, firstly, they are not comparable, but then even if we still had to compare them and we say that mutual funds are more expensive than ULIPs, well, it's only an estimate right now, which is more of a marketing estimate created by sales personnel. But what really happens is mutual funds could reduce their costs of management of funds over a period of time. ULIPs could increase the cost of management of funds. There's nothing stopping them either ways, and both of them are permitted to do so by the regulators. So it is imprudent to say that unit links are cheaper than mutual funds over a long term. They well could be more expensive. They could remain cheaper. One doesn't know. It's anybody's guess.
So investors need to be careful when looking at that. Well, Karthik, if you could compare unit-linked insurance products with term life, now with returns at over 20%, many will be tempted to go in for ULIPs. Which should be preferred and when?
Well, yes, I mean, this is a natural phenomenon that happens in a bull market. People tend to prefer that. But what one must remember is that ULIPs are policies wherein the mortality premium, which is the costing that is as a part of your premium, that tends to rise over a period of time. Now, as a result of which your sum assured that you start out with, and say after 5 years, the sum assured decreases. The more the markets boom, your sum assured is lesser and lesser. Whereas, on the other hand, if you want to have a level term cover, that is, you want to enjoy a cover for a certain number of years, then naturally term becomes a better option. For people who want to try and combine, the benefits of both mutual fund and ULIPs, that's the only place where one should look at ULIPs. But otherwise, term is still a better option.
Right, term is still a better option. Let's take a related query from a viewer.
I'm Shobna Thakur. I'm 35 years old. I have a son and a daughter, and I earn 4 lakh per annum. And till date, I have invested only in PPF. I want to buy an insurance plan, but I cannot decide whether to go for a traditional policy or a ULIP.
Okay, traditional policies, I would say, is basically out of the question. It really doesn't make a lot of sense to get into a traditional policy, as the rate of return that you'll get is really, really low. The best option would be, go for a term for majority of your insurance. Let's say insurance requirement was about 10 to 12 lakhs. You could buy most part of it as term, but however, you could buy a little bit of ULIP as well, maybe to the extent of 2, 3, 4 lakhs as a sum assured, but not a hell of a lot too much. The reason for that is very simple. See, as time passes by, markets will go up, markets will go down, and the cost of mortality keeps going up. And after about 45, 50 years of age, the ULIP mortality cost is very high and starts eating into your funds, and it starts eating pretty rapidly, which is why don't overexpose yourself to ULIPs. PPF is a good investment. You continue doing that as well. There's no problem doing that. But I think a term with almost 60% of your insurance provided by term assurance and the balance by ULIP should be a good combination.
So look at a good mix between ULIP and term. 60-40 is what Karthik is saying. And also a lot of people who had gone in for money-back policies wrote in to us and wanted a comparison between the money-back and term life policies. So Karthik, which is a better option?
Oh, without a doubt, term life is a far, far better option, because most money-back policies, the traditional ones, we can even have a look at, for example, LIC's website, which has even, it's explicitly announced that they've given a bonus rate of about 4 to 4.5%, which is far lesser than even our bank fixed deposit rate. And as a result of that, I mean, if you just take an example, say you're going to put about 50,000 odd premium for a 10 lakh cover, what would happen is over a period of, say, 25 years, you tend to invest almost about 12 to 13 lakhs as premium, and for which you get for a return of about 16 odd lakhs. Versus if you actually did a combination of term policy, your premium is as low as about 3,000, 3,500 approximately, and the balance, if you could invest in a PPF or even for that matter a mutual fund, the kind of returns that you would get will be far higher. In fact, for the same investment of 13 lakhs, you might walk home with as much as about 37, 38 lakhs with a PPF combination, and if you chose a mutual fund combination, you would well walk home with about 65 to 70 lakhs.
Right, so term life there, that's what Karthik is saying. Let's focus on pension plans now. In the last episode, we had said that a retired person should go in for this plan. However, we've got a couple of viewers who are not convinced. They argue that a person around 27 to 30 years of age should go in for pension plans. The premiums would be less in most cases, no medical checkup, and most importantly, quite a large sum would be accumulated for the future. What's your take?
Definitely, one should have a pension plan. The logic is correct that you should have it when you are young. But let's look at two scenarios here. First, let's talk about the people who are already retired or nearing retirement. Now, they don't have much of an option but to get into an immediate annuity kind of a product, or a product which is going to give them a mix of maybe 30-40% equity exposure and the balance in debt exposures, because they need to have a monthly income. So that's for the elderly people. Talking about the younger generation, they need pension, but you see there's a problem there. The problem happens when these guys will retire. While they are during their workforce, during their working years, they're going to accumulate a lot of money. So obviously when they're young, they start investing into this policy. By the time they retire, they'll have a huge corpus, no doubt about that. Problem happens when they retire, because in the corpus that they've generated, the insurance company would normally ask them to take an annuity from them or from anybody else in the market. And that annuity that time is only 2 or 3%, or whatever is the interest rate at that point of time in future, maybe 10, 20, 30 years later. Now, that's where the problem is, because your money is then blocked. You can't really provide for a lot of your expenses. Then what do? Either you compromise, or you have to compromise on your lifestyle. So that's where the problem of unit-linked, or for that matter, any pension policy really is. And just because it says pension policy doesn't really mean we should get in for it.
Right, and of course, Karthik, inflation also plays a key role there, isn't it? By the time you're ready for the money that you've invested, the costs just go higher and higher.
Absolutely, and then what do? Because you don't have the freedom to take away your entire corpus and do what you want with it. Versus if you actually did an alternate investment, you would have your entire corpus accessible to you. In this kind of policies, you will have only 1/3 accessible, and for the 2/3, you will have to buy compulsorily an annuity. So once in our Indian environment, if that becomes open, that you can earn higher rates of return, you can choose how you want that money to be deployed, just the way you do before your retirement years, then such policies will become a great option.
Right, so know your pension plans before you buy one. That brings the first segment to a close, but don't go anywhere, especially if you have kids and are thinking about their futures, because after the break, we'll take a close look at educational insurance plans.